Imagine running a business where the fundamental rules of the national economy literally change between the time you clock in on Monday morning and when you leave on Friday afternoon.
Right. Yeah. Like you're operating in a completely different reality by the end of the week.
Exactly. And that wasn't some hypothetical stress test scenario in Argentina in 2024. That was, just a Tuesday.
Oh, absolutely. I mean,
Yeah.
you're talking about an environment of extreme inflation, sudden currency devaluations, and just massive regulatory rewrites happening in real time.
Yeah.
It is basically the ultimate test of corporate survival.
Which is exactly why our focus for this deep dive is so compelling. We're cracking open the 2024 integrated annual report of a leading private bank that was operating right in the eye of that storm.
Right.
And just to keep to our strict anonymity rules here, we're simply going to call them the company.
Oh,
But, to really understand how they navigated all this chaos, you first have to look at their DNA because they have a pretty bizarre and fascinating ownership structure.
yeah. Bizarre is definitely a good word for it. Over 80% of this company is owned by a massive Brazilian banking giant.
Okay.
But then, holding a roughly 15% stake, you have the Argentine State Pension Fund.
Wow. So you've got this colossal private international backstop on one side,
Yeah, yeah.
and then these deeply embedded institutional local roots on the other. I mean, that has to completely change how they approach risk, right?
It dictates everything. It gives them a mandate to support the local economy, but with the financial firepower and the strict governance of an international player.
Right.
And when you look at the financial panorama for 2024, that dual DNA really paid off.
Okay, lay the numbers on us.
So the company finished the year with a comprehensive income of 173,563 million.
Wow.
Yeah. Total assets actually surpassed 6,000 million.
That's 6 trillion basically.
Exactly, yeah. And their net worth stood at 1,311,208 million.
Okay, I have to pause you there because we're throwing around words like million and trillion. And earlier I saw their return on equity, or ROE, came in at 16.2%.
Right, 16.2.
So if you're a listener managing your own portfolio, you might look at a 16% return in a hyperinflationary environment and think, is that actually good? Like, shouldn't it be way higher just to keep up with inflation?
And that is the exact perfect question to ask. Because look, in a stable economy, 16.2% is phenomenal.
Right. You'd be thrilled.
Exactly. But in a volatile one, you really have to look under the hood. The achievement here wasn't about aggressive, sky-high nominal returns. It was really about capital preservation.
Okay.
They played a brilliant game of defense. So, for example, late in the year, the broader banking sector got absolutely hammered by massive defaults in the agricultural sector.
Oh, right. Like farms going under and just taking their loans down with them.
Yes, but this company maintained a highly defensive posture all year. They kept their non-performing loan ratio, that's, the percentage of clients defaulting on their debt, they kept that significantly below the market average. Their commercial portfolio remained almost entirely insulated from those agricultural shocks.
So that 16.2% ROE is essentially a massive win because it represents high-quality, secure earnings rather than, inflated high-risk gambles.
Sort of spicy.
But, I mean, defense alone doesn't generate an income of 173,563 million. They had to take some punches. So let's get into the mechanics of what actually went wrong. What were the absolute biggest headwinds they faced last year?
Well, there were three major hurdles, and they actually triggered sort of a chain reaction.
Okay.
It started with what we call the interest rate squeeze.
Let's break that down. How does a bank get squeezed on interest rates when inflation is falling? That feels counterintuitive.
Right, so think about a bank's core business model. They borrow money at a certain rate and lend it out at a higher rate.
Right, the spread.
Exactly. The difference is their margin. Well, in 2024, as inflation began to show signs of cooling, the central bank started slashing interest rates.
So the amount the bank could charge for a loan just dropped.
Drastically.
Yeah.
To give you the hard numbers, the company actually grew its commercial loan portfolio by nearly 60%.
Wow, 60%.
Yeah, they were pushing significantly more capital out the door. But because the rates dropped so sharply, the actual interest income they made from private non-financial loans plummeted by 29.3%.
Wait, really?
Yeah, it was a drop of 254,663 million in income, which brought their total interest income down to 613,626 million.
Okay, if I'm understanding this correctly, they did 60% more work? took on 60% more exposure, and made 29% less money on the core interest spread.
That's exactly it.
It's like running faster on a treadmill but burning fewer calories.
That is a perfect analogy.
I mean, if your profit margins per transaction shrink that violently, you can't rely on your old business model. The
Yeah.
only way to survive is to drastically increase your volume.
Which leads us directly to challenge number 2.
Yeah.
Navigating a shifting macroeconomic playbook. Because they needed that massive volume, they had to move incredibly fast. But by mid-year, the central bank suddenly suspended certain operational facilities that banks use to manage liquidity.
Wait, what does that actually mean on a day-to-day level for a bank?
Well, banks make money by basically predicting the future of cash. They need to know exactly how much liquid cash to keep in the vault for daily withdrawals versus how much they can safely lock up in long-term loans.
Right. You don't want a bank run.
Exactly. So the central bank provides tools like short-term bonds or deposit facilities to help banks balance that scale every single night.
Okay.
When the central bank suddenly suspends those tools while they're restructuring the national economy, the bank's liquidity risk matrix just gets thrown into total chaos.
Wow. So the rules for how you balance your checkbook changed overnight, right when you were trying to push record amounts of volume out the door to beat that interest rate squeeze.
Exactly. It's the worst possible timing. And because they were pushing that volume so aggressively, leaning super heavily into digital channels to reach more customers faster, they inadvertently opened the door to challenge number 3, which was a massive industry-wide spike in digital fraud.
I noticed this in the sources. The company faced a huge surge in fraud-related customer complaints. But it wasn't just your standard click this link to reset your password phishing scam, was it?
No, it was much more systemic than that. Customers were suddenly finding unrecognized voluntary insurance policies attached to their accounts.
Wait, how does that even happen? How do you get an insurance policy you didn't ask for?
It comes down to friction in the digital design. When a bank digitizes its loan processes, they often bundle complementary products like life insurance on a personal loan, for example.
Right.
Fraudsters, or sometimes honestly just poorly designed algorithms, were taking advantage of rapid, frictionless digital approvals.
Oh, I see.
Yeah, customers were clicking agree to a loan without realizing a secondary policy had been attached in the fine print.
It's the dark side of a seamless user experience. Like,
Yeah.
if it's too easy to click buy, it's way too easy to get taken advantage of.
Precisely. So they had to completely revamp their internal resolution processes just to handle the sheer volume of complaints.
I can imagine.
And more importantly, they had to tighten their point-of-sale verification just to ensure that when a customer finalized a digital contract, there was absolute clarity and consent.
Okay, so we have a pretty clear picture of the battlefield here. You've got shrinking margins, forcing a push for volume, changing central bank rules, complicating liquidity, and a rush to digitalization sparking a massive wave of fraud.
Yeah, that's a lot.
So let's look at how they went on the offensive. Because from what the sources show, they didn't just survive this, they executed some of the biggest strategic moves in their entire history.
They really did.
Yeah.
And the first major event of the year was a direct response to that fraud and volume problem we just talked about.
Yeah.
It was a massive technological overhaul.
Okay.
They didn't just patch their existing software. They completely ripped out their digital service channels and migrated to a hybrid cloud architecture powered by microservices.
Okay, so I hear terms like hybrid cloud and microservices constantly in these corporate reports, and usually, I'll be honest, it's just buzzword bingo.
Right, totally.
Explain the actual mechanism here. Why does the end user or, our listener actually care about microservices?
Okay, think about the digital infrastructure of a traditional bank, like a single massive container ship.
Yep.
And it's carrying all the bank's services, loans, transfers, credit card payments, account balances.
Okay, I'm with you.
If that single ship hits a sandbar, everything stops. The whole app crashes.
Which is catastrophic if you are actively trying to drive record transaction volume.
Exactly. So moving to microservices is like replacing that single huge container ship with thousands of independent speedboats.
Oh.
And each speedboat is carrying just one specific function. So if the speedboat handling password resets breaks down, the speedboat handling money transfers just keeps zooming right past it.
Oh, wow. So for the user, it means the app basically never goes down, even during massive traffic spikes on, like, payday.
Exactly. Is
Yeah.
the hidden architectural foundation that makes high-volume banking possible.
And they absolutely needed that foundation to support event number two, which
Hmm.
was their aggressive product innovation.
Right.
Because to beat the interest rate squeeze, they basically flooded the market with new ways to lend, didn't they?
They did. They relaunched inflation-linked mortgage loans, which, by the way, is a massive psychological boost for the local real estate market.
Yeah.
They introduced a specific MX account tailored for small and medium enterprises.
And I actually love what they did with the younger demographic. They launched a 100% online platform for young people. And to build the habit early, they literally deposited a cash bonus into the accounts of young users who made their very first mutual fund investment.
It's brilliant customer acquisition, really.
Mm.
You pay them to learn how to generate fees for you later.
Right.
And the strategy worked. This aggressive product blitz resulted in an explosive 236% growth in their private sector loan portfolio in a single year.
Okay, I have to interrupt here because as an investor, if I see a bank triple its loan book in 12 months, my alarm bells are deafening.
Oh, absolutely.
Right. Because in traditional banking, 236% growth usually precedes a catastrophic collapse. You generally don't grow that fast without dropping your underwriting standards and lending to people who just can't pay you back.
Right.
How did they fund this without blowing themselves up?
That is the crucial question. And it brings us to event number 3, their dominance in the capital markets. To lend that much money safely, they utilized financial trusts.
Give us the quick, plain English breakdown of how a financial trust actually protects a bank.
Okay, let's say the bank issues 1,000 new car loans. Instead of holding all the risk of those loans on their own books, the bank bundles those loans together and transfers them into an independent, legally separate entity, the financial trust.
Okay.
The trust then issues bonds backed by the payments coming in from those car owners, and investors buy those bonds.
So the bank gets its cash back immediately to go make more loans, and the risk is shifted entirely to the investors who bought the bonds.
Yes. But the key thing here is that investors will only buy those bonds if they actually trust the bank's underwriting in the first place.
Right. They aren't going to buy garbage.
Exactly. And despite the deeply uncertain national context, this company led the market in placing these trusts. Furthermore, their international correspondence, which were heavily bolstered by the reputation of that Brazilian parent company.
Right. The DNA we talked about.
Yeah, they kept vital foreign funding lines open. Institutional investors looked at the chaos in Argentina, looked at this specific company's balance sheet, and basically said, we trust you to manage our money.
Wow. So they have the structural capability to grow by 236%, but that still leaves a massive, ethical and risk management question.
It does.
When you are pushing capital out the door that aggressively, how do you know you aren't funding a disaster? Like, how do you ensure you aren't financing a massive soy farm that's illegally deforesting a region or a manufacturing plant with horrific labor practices?
Which transitions us perfectly into their ESG framework, environmental, social, and governance. They aren't just treating ESG as some sort of PR exercise. They are actively tying their massive financial scale to these metrics as a literal form of risk mitigation.
Let's look at the mechanisms then. Starting with the E, environmental, what does this actually look like in practice?
It looks like an incredibly strict bottleneck. In 2024, they ran 2,994 individual credit proposals through a United Nations environmental and social risk filter.
2,994 proposals. How much capital are we talking about here?
A staggering 9,302,836 million.
Wait, over 9 trillion in credit proposals forced through a sustainability sieve.
Yes.
How does that UN filter actually work?
So it relies on the UN's International Standard Industrial Classification. It's an automated mechanism that cross-references the client's industry, location, and operational footprint against known environmental hazards.
Okay.
So if a massive agricultural conglomerate applies for a multi-million expansion loan, but the algorithm flags their GPS coordinates as overlapping with, say, protected wetlands,
It just flags it.
the system literally halts the loan. It forces the bank's risk committee to manually verify the environmental impact before a single dime is released.
Wow, that is a massive operational lift. Not to mention internally, they also cut their own energy use by 7.4% and sourced 20% of their headquarters power from renewables.
Right, they're doing the internal work too.
But the sources also pointed out a pretty candid limitation here. What's the major risk they are still wrestling with on the environmental front?
It's Scope 3 emissions. specifically regarding their oldest corporate clients.
Scope 3 being indirect emissions, right?
Exactly. The bank openly acknowledges the vulnerability of financing massive legacy corporations that entirely lack their own green transition strategies.
Oh, I see.
If the bank has strict internal climate goals, but their biggest clients are dragging their feet on emission reductions, the bank's indirect carbon footprint remains huge. It's this really delicate diplomatic balance. Like, how hard can you push a legacy client to modernize before you just have to cut off their funding entirely?
That is a really tough tightrope to walk.
Very.
Let's move to the S, social.
So on the ground, they mobilized over 1,000 employees for corporate volunteering programs across the country. And more strategically, they actually won an award for a financial literacy program aimed specifically at seniors.
Which feels directly connected to our earlier conversation about hyperdigitalization and fraud.
It absolutely is.
Yeah.
Moving everything to the cloud and relying on self-service apps creates a massive risk of exclusion.
Yeah.
If you are an 80-year-old who relies on physical interactions to understand your finances, a bank with no tellers isn't efficient. It's terrifying. The social risk of technology is that it can actively disenfranchise vulnerable populations. The literacy program is a direct attempt to bridge that gap.
Because you can't just innovate yourself out of human connection.
Exactly.
Finally, let's look at the G, governance. What's the mechanism keeping the house in order?
Well, they aligned their corporate sustainability policy with the UN 2030 agenda and proudly reported 0 confirmed cases of internal corruption.
That's always good.
Yeah, but the most significant mechanical upgrade was finalizing a brand new anti-money laundering platform, or AML, which goes live in early 2025.
Makes sense, because if you're tripling your loan volume, your compliance team can't just drink 3 times as much coffee.
Right.
You need an automated guard at the gate. How does the new AML platform work?
It essentially shifts the bank from reactive monitoring to proactive behavioral profiling.
Oh, interesting.
The old way of doing AML was setting arbitrary limits, like flagging any cash deposit over a certain amount. The new automated models look for behavioral anomalies.
Give me an example.
Okay, if a local bakery that usually deposits small, predictable amounts every Tuesday suddenly receives a massive international wire transfer from a high-risk jurisdiction,
Right.
the system flags that behavioral deviation instantly, freezing the funds before they can be layered into other accounts.
Got it. So they've survived the macroeconomic roller coaster of 2024. They've rebuilt their digital architecture, and they've installed these massive ESG and AML filters.
Yep.
What is the roadmap now? Let's dive into their stated objectives and priorities for the upcoming year.
They have 3 critical priorities for 2025. Priority number 1 is taking that microservice architecture we discussed and using it to deliver hyper-personalized digital experiences.
So moving beyond an app that just doesn't crash to an app that actually thinks.
Exactly. The operational goal is deploying what they call pure cloud technology across all their contact centers.
What does that mean for the user?
They want to integrate their mobile apps so deeply with customer service that if you encounter an error while trying to make a transfer, the system actually anticipates your frustration.
Oh, wow.
Yeah, it offers a one-click solution or connects you to an agent who already has your exact error code on their screen before you even say hello. Seamless, anticipatory self-service.
That sounds incredible. And priority number 2 seems to be a pure, aggressive market share land grab, specifically targeting the corporate and education sectors.
Right. They are currently the leading financial agent for public universities in the country. Now, they are systematically targeting private universities.
Which is the same logic as the youth investment bonus we talked about, right?
Exactly. Get the students into the ecosystem early, embed your services into their tuition payments, and keep them for life.
And on the corporate side,
the board of directors literally just approved pushing their corporate credit limits to the absolute maximum allowed by the central bank. They are flooring the accelerator.
But, flooring the accelerator brings us to priority number 3, rigorous internal housekeeping. Because if you drive that fast, you need phenomenal brakes.
And their brakes are their internal audit teams. The company has mandated over 200 internal audits for 2025 alone.
Wow.
And they are deploying a newly designed dynamic matrix to proactively monitor their entire branch network.
I love that concept. It's like the eye in the sky at a casino.
Oh, that's a good way to put it.
Like, it's not just a camera watching the dealer's hands to see if they steal a chip. It's a software system analyzing the betting patterns of every single player at the table, looking for subtle deviations that tell you someone is counting cards before the casino ever actually loses money.
That is the perfect analogy. The dynamic matrix is designed to spot operational anomalies before they crystallize into actual financial risks.
Right.
The true ambition for 2025 isn't just raw growth. The real goal is executing this massive corporate credit expansion while keeping that stellar non-performing loan ratio completely intact.
Yeah.
It requires extreme aggression in sales, paired with deep structural conservatism and risk assessment.
All right, we have covered a massive amount of ground today, pulling apart a deeply complex corporate strategy. Let's distill this. What are the three key takeaways you, our listener, should walk away with today regarding how to navigate extreme business volatility?
Number one, when the fundamental rules of your revenue stream change, like interest margins collapsing, you cannot rely on your old pipeline. The company executed a strategic pivot to sheer volume, aggressively launching new products to grow their private loans by an astonishing 236%.
Number two, you cannot scale volume without re-architecting your infrastructure. They didn't just patch their systems, they moved to a hybrid cloud and microservices model to eliminate friction, prevent cascading app failures, and close the vulnerabilities that led to digital fraud.
And number three, massive growth requires massive risk filtration. They didn't abandon their ESG commitments to chase revenue, they fully integrated them. They pushed over 9,302,836 million in credit through strict environmental matrices and are launching advanced behavioral AML platforms to ensure their growth doesn't fund bad actors.
It truly is a masterclass in building a resilient corporate machine. But I want to leave you, our listener, with a final thought to mull over based on everything we've unpacked today.
Let's hear it.
We've talked extensively about this company pouring, billions into microservices, hybrid clouds, and anticipatory AI to make their digital experience flawless. They are essentially transforming into a tech company that just happens to hold money.
Right.
So if 98% of your banking relationship eventually lives in the cloud, what happens to that physical bank branch on the corner of your street? Does it become a completely obsolete relic of the past, or is it going to transform into something entirely new? Maybe a premium advisory hub we haven't even envisioned yet.
That is the ultimate strategic question for the next decade of finance, isn't it? Figuring out the balance between high-tech efficiency and high-touch human empathy.
It's going to be fascinating to watch unfold. Well, thank you so much for joining us on this exploration of corporate survival and strategy. We appreciate you taking the time to unpack the numbers with us, and we hope you'll drop back in for our next deep dive. Until then, keep asking the hard questions.